So it's October, November 21, paper 12. Come on, go through the first question. Tell me what the answer would be. You have included unpaid wages. Which accounting concept is being applied? When you minus the prepaid and you add the outstanding. When you minus the prepaid and you add the outstanding, which accounting principle are you applying?
Matching.
Matching. How does this matching come into picture?
That was looking much better than the rest.
That was looking much better than the rest. See, basically in matching principle, what do? You record the expense for the year. Expense for the year. Whether you have paid or not paid. This you compare with the income for the year. Whether you have received or not received. So that you get the profit for the year. So matching principle says that the income for the year should be compared with expense for the year so that you get profit for the year. It does not matter whether you have paid the expense or not, received the income or not. Also, provision for bad and doubtful debts is recorded for keeping in mind the matching principle. What do they say? That if you have earned the revenue, if you have sold goods on credit, and from that sales, if you expect any probable loss, so that should be recorded in the year of sales. Matching principle tells us. Okay. Can I go to the next one? If your business is not a going concern, that means you don't expect your business to last longer. Then on which basis will you record your non-current assets? If your business is not a going concern, then you record your non-current assets at the amount at which they could be sold for. Okay? Otherwise, you record your assets at net book value. What is net book value? Cost minus accumulated depreciation to date is net book value. If it is a going concern, you record your non-current assets at net book value. If it is not a going concern, then you record your non-current assets at the amount that they could be sold for. Go to the next one, read, analyze. I will mark the important information, I'll highlight it.
Because it will be D, no?
Hmm?
D.
Come on, tell me how.
Because the depreciation for the current year would be 300 and the total depreciation will be 1500. Last year's 1200 plus current year's 300.
Okay. In 2019, full year depreciation is 12,000 into 10%. So 2019 depreciation is 12,000 into 10%. So it is 1,200. And 2020 depreciation would be, so balance begin down would be 1,200. And current year depreciation would be 12,000 into 10% into 3 months. So it is 300. So current year depreciation 300 up till March. And because you've disposed it, so on the debit side, you will write the total depreciation. Answer D. Anybody has any doubts for this?
No, ma'am.
Go on the fourth one. Okay. So straight line method, depreciation, when the rate of depreciation is not given, how do you calculate the depreciation per year? Cost minus estimated scrap upon estimated useful life. What is the cost? The cost is 500,000. What is the estimated scrap value? 100,000.
20,000 answer.
What is the
For
estimated useful life? 20. So what is the depreciation per year?
20,000.
How much?
20,000.
20,000 is the depreciation per year. The non-current asset was sold after 10 years. So 10 years depreciation would be
200,000.
20 into 10, 200,000. Net book value would be cost, that is 500,000, minus depreciation to date, that is 200,000. This will give you your net book value. What is your net book value?
So I have a question.
300,000. Yes?
Does the selling cost add up in the any of the
No,
thing?
you will minus the estimated selling cost.
Selling cost is 10,000. So will I minus that with the profit, with the money I get?
Yeah, so you are going to sell it for your 110,000.
Yeah, because I subtract the cost, no?
Yeah, the estimated selling cost to get the NRV.
The
So
answer
it is,
should be B.
so 300,000 was the book value and sold for 110,000 after deducting the selling cost. So book value 300,000 and it is sold for 110,000. So what is your profit or loss on disposal? You have loss on disposal. How much?
190.
190,000. Am I very clear with this? Zara,
Yes, ma'am.
understood?
Yeah,
Come on, let's go ahead. Which items are capital expenditure? Capital expenditure means cost of buying the asset up to using the asset for the first time.
Also the installation cost, no?
So this is capital expenditure. This is capital expenditure. So what would be capital expenditure?
Will it be A?
102.
This is revenue expenditure. This is revenue expenditure. Come on, the next question is from control accounts.
Okay.
Sales ledger control account had a debit balance of 15,000. These errors were discovered. Return outward had been credited in sales ledger control account. What is return outward? Purchase return. And purchase return comes in PLCA. But what did you do?
Credited. So it will be debited.
It will be debited. Very good. Contra entry with the PLC account 400 had been debited in the SLCA.
Credited by
Contra comes here, but you
credit
wrote
side.
it here. So to correct it, you will write 400 once to correct it and 400 once for the actual effect. Now, customer's balance 300 had been written off in SLCA,
That won't be recorded.
but no entry has been made in sales ledger. So we are not making sales ledger, we are making SLCA.
Answer is A.
So which figure for trade receivable should appear in the statement of financial position? So it would be 15,200 minus 800. Answer is A. I hope this is clear. I hope this is clear.
Yes, miss.
Yes, ma'am.
Okay. Bank account had a debit balance of 5760, but in the cash book. Now remember, cash book and bank statement works separately. Cash book in is debit, out is credit. And bank statement in is what? Credit and out is debit. So in the cash book, bank account had a debit balance of 5760. Following items were identified when we tried to reconcile the bank account with the bank statement.
Miss, I have a question over here.
1 minute. We have to show the amount that has been shown in the bank statement. Yeah, tell me.
The balance was at 31st May. So the opening balance will be somewhere else.
Now you are doing reconciliation on 31st May only, right? So I want the balance as per bank statement. So amount not yet credited by the bank 900. That means bank did not record 900 over here, but I have recorded 900. So I will prepare bank statement over here only. I'm doing the rectification in this only. Bank has not recorded 900 over here. That means the bank statement balance would be less by 900. So I'm putting on the credit side. Any doubt?
Miss, can you repeat that?
Bank account is same.
See here, no, I am doing it same, a shortcut. Amount not yet credited by the bank. Credited by the bank means bank has not put it inside over here. Okay? I have put it inside over here. I have put the money. Cash book shows this 900 on the debit side, but bank statement does not show it. Okay, on the credit side. Or you'll want to do it in the normal way. Well, let's do it the normal way. Come on. First thing is that we'll update the cash book. How do we update the cash book? With things that happened in bank statement but not in cash book. So 120 bank charges has been already deducted from the bank statement, but it has not happened in the cash book. How about dishonored checks?
So this is cash book or bank account.
This is cash book. I'm updating the cash book.
In the brackets, why you've written bank account?
This is cash book bank account. Cash book has two columns, right? Cash and bank.
Yeah.
So we are only dealing with the bank account. So there is one thing, 120 bank charges. This happened in the bank statement. And also in the bank statement, there was a dishonor of 340. So two things happened in the bank statement. Reflection was not there in the cash book. So first I'm updating my cash book. Get me the updated cash balance. It would be 5760 minus 120 minus 340. So 5300 is the balance as per cash book. Balance as per updated cash book. Now I have to reach as per the balance as per bank statement. Balance as per bank statement. Come on, do you know if you start with balance as per cash book and you have to reach as to balance as per bank statement, what do you add and what do you subtract? Do you know that? Try to recall.
Yes, we add the uncredited deposit and minus unpresented check.
We add the uncredited deposits and less the unpresented checks. Anything else? Come on, let's see. Let's go together. You can you see my video? Can you see my video?
Yes,
Okay, fine. Look over here. Now, this is balance as per cash book. This is balance as per bank statement. Okay? Balance as per cash book and balance as per bank statement. What happens is, this is the amount not yet credited by the bank. That means the bank has not yet put the amount in the bank. Okay? I have already put in the cash book, so the cash book balance is high. I have already put in the cash book balance is high. But the bank statement balance is low because the bank did not credit it. So I want to go from the cash book to the bank statement. I want to go to the cash book to the bank statement. So from a higher balance, I want to go to a lower balance. So what will I do? I will subtract. So I will subtract uncredited deposits. What will I do? I will subtract uncredited deposits. Are you with me?
yes, ma'am.
Okay. Fine. Now unpresented checks. Unpresented check, that means the cash book has already issued the check. Cash book has already issued the check. That means the cash book balance is lower. But the bank statement has no reflection of this check because people did not go and present it. So the bank statement balance is higher. Are you with me? Are you with
Yeah.
me?
Yes,
Okay.
what happened to the checks?
You have
It's
issued a check. So you reduce your balance in the cash book. But the bank statement has no reflection of this check because people did not go to present the check. So from a lower balance, you want to go to a higher balance. You are going from cash book to bank statement. So what will you do? You will add the unpresented checks. Now for BRS, what you do now, you will start with the normal balance that is given to you. Don't go into updated checkbook. Just go into think from this point of view itself. Come on. We did this. We did this. Now bank charges. Come on. Bank charges means bank has reduced the balance. But the cash book balance was high. From the higher balance, if you want to go to a lower balance, you're going from cash book to bank statement. What will you do? Add or less? I will less. Bank charges 120.
So why less?
See, bank has already reduced the balance because of bank charges. Okay? But the cash book balance was higher. So from a higher balance, if you want to go to a lower balance. From higher balance, if you want to go to a lower balance, you're going from the cash book to the bank statement. So from cash book to the bank statement, from cash book to the bank statement, so I will do less. Are you with me?
Do you have debit credit thing?
Sorry?
There's no debit credit explanation.
No. You just have to think from where to where you have gone, what has been done in the cash book, what has been done in the bank statement. And then you see from higher to lower, you have to go, from lower to higher, you have to go. Come on, now think for dishonored checks. Please think from dishonored checks.
So I have not received and I have not recorded that I have not received.
Sorry?
So I have not recorded that these are dishonored.
Okay, now let's see. Dishonored checks. You had received a check, okay, and you wrote it on the debit side of the cash book. So the cash book balance was more. But the bank statement did not honor this check only. Okay, this is a dishonored check. So as per the cash book, the balance was more, but as per the bank statement, the balance was less. You want to go from the cash book to the bank statement, from higher amount to a lower amount. So what will you do? You will subtract this 340. So you will subtract this 2 and you will come as a balance as per bank statement. I want you to, then we'll add 5,760 plus 740 minus 900 minus 120 minus 340. So you get 5140. So the balance as per bank statement is 5140. I'm giving you all some time and I'm pausing the video. Reflect on this and then tell me done or no. This method is not comfortable. You can do is you can memorize this. You can first update your cash book. Things which has lowered your bank statement balance. Okay, things that has reduced the bank statement balance, you update it in your cash book. So one was the bank charges, Because of bank charges, the bank statement was lower, and you could not record it in your cash book because you got to know it later. And because of dishonored checks, your bank statement was lower. So you get a new balance as per cash book, which comes up to 5760 minus 120 minus 340. You get a new balance as per cash book, that is 5300. And then you can memorize this format. You start from cash book and you have to reach to balances per bank statement. Cash book to bank statement. Add unpresented check less uncredited deposit. Add UC and less UD. Add unpresented check less uncredited deposits. This you can memorize.
Okay, miss.
Okay. What will you memorize?
Yeah.
Tell me.
In cash book, we put all the changes.
Okay. In the cash book, in the updated cash book. In
Okay.
updated cash book, what will you do? You will write your balance as per cash book and everything that happened in the bank statement. You will record only in the bank statement, cash book no. Something that has happened in the bank statement but you don't know about it, like bank charges here. Okay, then what are the other things that would come over here? Dishonored checks here. Okay, on the debit side, this could be direct deposit by the customer, direct deposit by the customer, and interest credited by bank. These are the maximum items that you could have. You come at your updated cash book balance. Then what do? You add unpresented check
And less unpresented.
and less uncredited deposits.
And
So you will come as per balance as per bank statement. Otherwise, there is a video of DRS on YouTube. You can go and see it and try to do it. Or you memorize this. Come on. Try doing the next one. Where do we record sales invoice? Sales invoice is first recorded in the sales ledger, in the sales journal. And from the sales journal, you record total sales. You record total sales in general ledger. In sales account, credit side, sales for the month. In the sales journal looks something like this. A, 800, B, 600. Okay, these are your individual customer. Individual customer's account is maintained in sales ledger. Sales ledger has the personal account of all your credit customers. Okay, sales ledger has all the credit customers' personal account. This represents an SLC. So they want to know where do you record individual sales. So individual sales is recorded in the sales ledger and individual sales is also recorded in the sales journal. Okay, sales ledger control account, no.
So what's the difference between sales ledger and sales ledger control account?
Sales ledger control account and sales ledger. Okay, they both are the same. But what is happening is, in sales ledger, you make your individual customer account. And sales ledger control account is kept in general ledger. SLC account, this is also your individual customer account. Okay, but this is maintained by the errors department who control errors. So this is totally separate. So if you see this and this both are the same. Even here you have your individual customer account, even here you have your individual customer account. But this is normally made by the control department who is going to check your sales ledger. So the most correct answer is the A1. Go to the next one, try doing it. Working capital is what? Current assets minus current liabilities. You had a set off of a sales ledger balance 600. Set off means you will minus from the trade receivables also, you will minus from the trade payables also. So your new trade receivables is how much? Your new trade receivables is 9,400. Your new trade payables will be how much? It will be 5,500. You also had to create a provision for bad and doubtful debts. So from this you will minus 5% PDD. So 9,400 into 5% PDD is 470. So your new trade receivable balance is 8930. This is the effects of the adjustments. Now they want you to calculate working capital. So working capital is current assets minus current liability. So the new trade payable was 5,500 and bank overdraft remains the same. So 8930 minus 5,500 minus 1,900. So this is 1530. Answer is C. I hope you're through with this.
Yes.
If you're through with it, you go on the next one. Others can still sit and do it. Come on, let's see. Freda's provision for doubtful debts includes a debit entry. That means on the PDD, you have done a debit entry. Over here you put an entry. Okay, fine. And the rate of provision has not changed. That means you have debited PDD for something else. Let's have a look at PDD. Provision for doubtful debts, it always has what balance? It always has a credit balance, number one. Number two, if there is an increase in the provisions, that means if there is an increase in the possible chances of having bad debts, it is a loss for us. If there is an increase in the possible chances of having bad debts, it means it is a loss for us. And if it is a loss for us, so we would say income statement debit and provision for doubtful debts credit. If there is a decrease in the provisions, that means it is a good thing for us. There is a decrease in possible chances of having bad debts. So we say income statement credit and provision for doubtful debts debit. So here it has a debit entry. Provision for doubtful debts is what entry? It has a debit entry. It has a debit entry, that means there is a decrease in provision. Decrease in provision, good thing for us. Decrease in the possible chances of having bad debts. What could be the reason for this? Rate has not changed. If trade receivable increases, rate remaining the same, so PDD would increase. So this is not the answer. Are you with me?
Yes.
If trade receivable decreases, rate remains the same. So provision for doubtful debts would also decrease. Provision of doubtful debts would decrease. So PDD debit. So this could be a correct one. So 3 is correct. So that means you have to choose between option A and option C. Now I don't need to read. Yeah, I have to read the second one also. PDD is a percentage of trade receivables. So if trade receivable will decrease, PDD would also decrease. Okay. Credit control procedure has been reduced. There are less people who are taking care of collecting money from the trade receivables on time. So if this will be reduced, that means your PDD will increase. So this is not the correct one. And if you have proper people to collect money from your trade receivables on time, or you have improved your credit control procedure, so that means your PDD will reduce. Okay? You're collecting money on time. So control procedures has improved. So 1 and 3 would be the answer. Take some time, reflect on it and let me know. Come on. What is the effect of the omission? Dua,
Yes, miss.
effect of omission 2.8% understated or overstated?
It's understated
Why understated?
because 26.5% is lesser without omission.
So effect of this omission is that your gross profit margin is 2.8% understated. Are you all with me?
Yeah, miss.
Okay. Are you with me? Are you all with me?
Yes.
Come on, go to the next one. So how many radios did William have? His statement of financial position shows $1,500 for inventory. So how many radios did William have? William had 150 radios. Because his method of calculation inventory was correct. So he was valuing inventory at cost. He was valuing inventory at cost on market value, whichever is lower. So he was valuing inventory at 150 radios into 10, that is 1500. So he had 150 radios. But later he found out that 12 radios could be sold for 8. So 12 radios he had to multiply with cost or NRV, whichever was lower. 4 was stolen. So this will not be a part of inventory valuation. So how many was the balance radios that he had? 150 minus 12 minus 4. So he had 134 balance inventory. And this would be valued at cost. So 1340 and 12 radios should be valued at 8. So 96. So 96 plus 1340. This would be the correct valuation after discoveries. So 1436 is the correct valuation. His statement of financial position shows inventory valuation at how much? 1500. Now after these effects, we have found the correct valuation. Correct valuation is 1436. So by how much he should reduce his inventory valuation?
64.
So he should reduce his inventory valuation by 64. Are you all with me? Are you all with me?
Yeah.
Can I go ahead?
Yes.
Did you all get the cost of sales? Did you all get the cost of sales? Did you all get cost of sales? Anybody, did you all get cost of sales?
No, it's not.
Aman?
No.
So try and find the cost of sales. Did you get gross profit? Cost of sales is 168,000. I converted from markup to margin, from cost to sales. Now cost of sales is made up of opening inventory plus purchases minus closing inventory. Cost of sales is 168,000. Opening inventory is 17,600. Purchases I have to find out. Closing inventory is 18,700. So this would be purchases minus 17,600 minus 18,700. So the answer would be negative. So purchases would be 168,000 plus 1,100. So it is 169,100. Only one option is there for purchases. 169,700. So the answer would be D. However, if we want to find out, we can find out still. 42,000 is the gross profit, and your expenses would be 11,900 minus 630 minus the prepaid. So your expenses is 11,270. So your profit for the year would be 29,470. 11,900 minus 630 is 11,270. 42,000 minus 11,270. 42,000 is the gross profit minus expenses paid and minus prepaid. 42,000 minus 11,900 minus 630. 29,470. Are you all with me?
Yes, miss.
Yeah, miss.
Are you with me? Okay, this is also expense for the year, okay, because it was prepaid last year. It was prepaid last year, that means it is expense for the year. So this is paid in the current year and this was paid last year for current year. Are you with me? So the answer for 13th is D. Let's go to the answer for the 14th one. Come on, try the 14th one. In the absence of partnership agreement, which statement is correct?
Miss, is it C?
Partners are not entitled to interest on capital. Yes, the answer is C. Nothing is allowed and profits would be equal. Go to the 15th one. Come on, try it. The company has issued shares 50,000 ordinary shares at a premium of 1 per share. I just want the total of reserves. So when you are issuing at premium, my share premium will increase. This is a capital reserve. So 50,000 into 1 share premium will increase by 50,000. Company's land was revalued upwards. That means there will be a revaluation reserve that will be created of 130,000. So my total capital reserves is 180,000. So it would be either option A or option C. Capital reserves. Then they paid dividend. Dividend is paid out of retained earnings. So from retained earnings, I will minus dividend. They want total revenue reserves. Revenue reserves is general reserves and retained earnings. So I will add the two. So it becomes 140,000. Are you with me?
Yes, ma'am.
So it is option A. Come on, the next one. Company revalued its premises upwards. Which statement is correct? If I revalue my premises upwards, that means the revaluation reserve would go up, but I don't receive any money. It is a profit. It is a profit, but this profit I don't receive in cash. So it is unrealized profit. So this statement is correct. It is not debited to revaluation reserve, it is credited to revaluation reserve. It is not recorded in the income statement, it is recorded in statement of financial position and statement of changes in equity. It can be used to pay cash dividend. It is wrong because I don't receive any money out of revaluation of assets either upwards or downwards. So it is an unrealized profit. Can I go ahead? Try the 18th one. What is non-current liabilities in statement of financial position? So I'll record assets here, liabilities here. Ordinary share capital. Okay. They have given me everything. I don't have to calculate anything. Non-current liabilities means liabilities that has to be paid after a year. So 150,000 would be my non-current liability. 75,000 bank loan would also be my non-current liability. How about mortgage on building? How about mortgage on building? Mortgage on building, that means you have kept your building on mortgage and you have to repay the loan or the mortgage that you created on the building. But it has to be repayable in 2021. That means it has to be repayable within a year. That means it is not a non-current liability. So only two non-current liabilities, 225. Go to the 19th one. Come on, read it. Non-current asset turnover ratio improved. Non-current asset turnover ratio improved between 2020 and 2021. Even though net revenue was the same for both the years. Can you give me the formula for non-current asset turnover ratio?
Sales over non-current assets.
Which value? Non-current assets at which value?
Net book value.
Net book value. Okay. Even though the revenue was the same, this was the same, but the ratio improved. Let's take a random figure. If revenue is 50,000, I'm taking random figure. Net book value over here, I'm taking 150, and over here, I'm taking 200,000. Check the non-current asset turnover ratio. This is 0.33. This is 0.25. So if non-current assets will increase, so the turnover ratio will decrease. So if non-current assets will decrease, the turnover ratio would increase. That means you're using your non-current assets better. What has caused an improvement in this ratio? A reduction in the level of irrecoverable debts. Bad debts reduce. Bad debts has connection with current assets. No. Upward revaluation of premises. If I revalue my premises upwards, that means non-current assets is increasing. Non-current assets increasing, that means the turnover should reduce. So even this is not correct. Depreciation is charged higher than the cost of new non-current assets. If depreciation is increasing, so non-current assets would reduce. If non-current assets is reducing, so turnover ratio will increase. So this could be the correct option. Purchase of new non-current assets greater than disposal. If I'm purchasing new non-current assets, means non-current asset will increase. If non-current asset will increase, so turnover will reduce. So even this is not the correct option. So correct option is this one, because of which the non-current asset is reducing. I have done a check over here to see when does my turnover ratio increase or decrease. Just go through it